Hi, the idea here is to present this PowerPoint on TJN's policies about the ABC and the G, basically explaining what they are about, but mainly what they address and how they interrelate with each other. So the A stands for automatic exchange of information. That refers to exchange about countries exchanging automatically in bank account information based on the OECD's Common Reporting Standard, or the CRS. The B stands for beneficial ownership, and that is about beneficial ownership transparency, where we ask countries to establish public beneficial ownership registries where they collect and publish information about the natural persons, the beneficial owners, who own, control, or benefit from different types of legal vehicles, such as companies, trusts, or partnerships. Country-by-country reporting, which refers to this big map describing a multinational's operations all over the world, where they have employees, how much money they make in each country, where they pay taxes, how much taxes they pay, and how many assets they have in each country. And the last one, which now stands for the G, is the Global Asset Registry. This is based on Zuckman's and Piketty's idea. And the Global Asset Registry would involve having a register, which might be public or not, or where some information might be public, about all the assets, such as real estate, cars, yachts, jets, livestock, gold, art, antiques, bitcoins, or anything that an individual owns. And this way, it would be possible to know, first, to measure inequality just by knowing how much money and how much wealth each person owns. And at the same time, to tackle illicit financial flows, such as money laundering or corruption, in case a person owns a lot of wealth and mansions and cars and yachts, but then they cannot justify how they got that in the first place because they don't have any declared income. That might be a case of drug smuggling or finance of terrorism, or it might also be a poor person that is simply being exploited to appear as the nominee owner of those assets when someone else is the real owner. So one way to look at it is what authorities are able to see, and this is based on what information is actually public. So in one case, we might have something which might look like a complete legitimate public tender, where three companies were competing to obtain an oil licensing to exploit oil in one country. So oil one is the one who finally got the license. And even though they're making a lot of money from oil, as the arrow indicates, in the end, they're not paying any taxes in the country. And they explain that even though they make a lot of money, they have so many costs that they have no profits. And that's why they don't pay any income tax. Now, where does all this money go? Where does all this profit go? So on the one hand, they are paying for some consultancy. In this case, it might be a Panamanian company that is offering this. And at the same time, there are a lot of transfer pricing, although authorities might think that it has to do with abuse of transfer pricing or transfer mispricing, where Oil One is paying a lot of money for marketing purposes to Ireland, for royalties to intellectual property in the Netherlands, and interest because of financing costs based on a subsidiary from Luxembourg. So that is the only thing that authorities get to see. And it may be very possible that they don't have enough information or comparables or anything to challenge all of these transactions. So in the end, they have to accept that Oil One, that is making a lot of money after winning the public tender, is not paying any income tax. Now, what is actually happening in reality? And we might start with the top left, and that is the tax abuse. So it's true that Oil One is giving all this money to Ireland subsidiaries and Dutch ones and ones in Luxembourg, but then all of the money ends up in Bermuda for different reasons, for different tax shenanigans. And in Bermuda, there is no income tax. So in the end, all the money that was actually made by Oil One in the country is being transferred somewhere else where it pays no tax. So that's a case of tax abuse. Now, let's look at the actual public tender. When we look at who was the actual beneficial owner of Oil One, we see that all three companies were actually owned by the same person, they all had a very complicated structure where they all were owned by a holding in a foreign country, but they all ended up in a trust which was owned or controlled or benefited by Mary. So there's a case of bid rigging. We thought that, again, this was like a competitive tender, but it was just, it was rigged. Now, we could think that there may be like actual independent companies like Oil 4 or Oil 5, but Oil 1 managed to win the license. And how did they do that? By corruption. So on the one hand, Mary is also transferring money to John, the minister, who in this case is deciding on who gets the license, to John's Swiss bank account. And that way they are paying him off. Thanks to this, now John has a lot of money in a Swiss bank account, and either with that money or with other money from other bribes, he also managed to buy a mansion in London and to own a yacht in Malta. And at the same time, there's even an extra case of corruption. Let's suppose that it's always John's family, because some of the payments that Oil 1 is doing, also, I mean, maybe part of it was just getting the money in the Swiss bank accounts, but part of the money is also paying John's son. And for example, they might have told Oil 1 Limited that if they wanted to win the public tender, they also had to hire this consultancy firm from Panama, and then pay the money just for no real consultancy, but just to simulate and just to try to give an explanation of why John's son is getting money. Now, as we saw, the only thing authorities see is just this. They don't see the corruption, they don't see the money laundering, they don't see that John's son is also involved, and they don't really know where the money from Oil 1 is ending. So here is where all the policy asks of TJN come into place. So the first one is automatic exchange of information. So it's not like automatic exchange of information would reveal all the corruption and all the money laundering and all the bid rigging. The only thing that it would solve in this case, in this example's case, is informing about John's bank account in Geneva. Supposing that Switzerland and this country exchange information automatically, Switzerland would have to report to the country, to the tax authorities, about John's bank account. And then what authorities could do is first check whether he has declared that account, in case that he has any income, or in case the country has also a wealth tax for which John should have paid taxes. And the other thing has more to do with the corruption and money laundering side, which is, can John justify how he got so much money? Let's imagine that he has $10 million. Let's think maybe his salary is only $100,000 per year, and John appears as having, again, this $10 million in a balance account of a Swiss bank account. So the question that could be reported to the FIU of the country is, can John justify how he got so much money, or should he be investigated for money laundering? Now, the B of the ABC has to do with the beneficial ownership. In this case, it would involve that all the companies involved in this country have to disclose all the legal owners and the full ownership chain until they disclose the beneficial owner. That is a natural person who actually owns, controls, or benefits from the company. On the one hand, in the left, we are seeing that this consultancy firm from Panama is actually owned by John's son. Now, to get this information, we need two things. Either Panama has a beneficial ownership register, which discloses this information publicly, and that's why the authorities can find out that John's son is the actual owner, or the tax authorities or the country where this is happening actually requires any company providing any service or operating in the country to disclose their beneficial owners. So these are the two ways in which the local country could find out about John, either because the country where the company, in this case Panama, has a beneficial ownership register, which is public, or because the country itself requires any company operating in the country, even if it's a foreign company, like this Panamanian one, to disclose the beneficial owners. And at the same time, just by requiring this disclosure of beneficial owners, the country would find out that Oil 1, Oil 2, and Oil 3, they all ultimately are owned by Mary, and that's why there's bid rigging. Now the C, which has to do with country by country, has more to do with tax abuse. In this case, the public tender is irrelevant as much as the owner of the Panamanian company. But in this case, what matters is that the country would be able to find out that all these payments to Ireland, to the Netherlands, and to Luxembourg for royalties, payments of cost or interest actually have to do with a tax avoidance or a tax abuse scheme, because in the end, all this money ends up in Bermuda, where they don't have to pay any income tax. The country-by-country report, in case the country obtains this country-by-country report by Oil One Limited, would disclose this. It would disclose that Oil One has many employees and a lot of income in the country, but they pay no tax. And it might also disclose that there are no employees whatsoever, or maybe only one or two, in all of these subsidiaries in the other countries. But in the end, no one is paying any tax and there are no assets, just because it's accounting shenanigans where the money is transferred, profits are shifted, and it all ends up in a country, in a tax haven, where no income tax is owed. And using this country by country, the tax authorities could at least try to object and to challenge all the transfer pricing documentation and the calculations and the formula used and the prices basically charged internally within this Oil One multinational that enable them not to pay any tax. And lastly, the Global Asset Registry would reveal, depending once it becomes once it comes into existence, depending on the scope, but ideally it could reveal all the cases. The Global Asset Registry should cover all the bank accounts held by John, either in Geneva or in any other country, all the real estate owned by John, either in London, Miami, or anywhere else, all the yachts owned by John, either in Malta, Panama, Marshall Islands, and the same with any other type of assets, such as livestock, gold, antiques, or bitcoins that are owned by John in any country. Of course, this will depend on those countries where these assets are located, say Switzerland, the UK, or Malta, to have interconnected registries of assets at the beneficial ownership level, so that we know that John is the owner of the house, and that John is the owner of the yacht, and that John is the owner of the bank account. Given this, authorities could find out first whether John paid any wealth tax on all of those assets that he has, or any income, supposing that any of the house or the yacht also create an income, such as rent. I mean, if the house is rented out to someone else. But then the other point, which has more to do with money laundering, is whether John can justify how he got all these assets and how he has all this wealth, given his low salary, which might not be able to afford all of those things that he owns. So in essence, in summary, country-by-country reporting on the top would be revealing and would be providing transparency to the tax shenanigans and the tax abuse, and how all the money is being shifted and the profits are being shifted towards a tax haven where no taxes are paid. Automatic exchange of information would cover mostly the bank account held in Switzerland. Beneficial ownership transparency, in supposing that we have beneficial ownership registries that are public, or that at least are available to authorities, would reveal the whole bid rigging based on who owns all the different companies involved in the public tender. I would also disclose the corruption happening with the consultancy firm, because it involves a conflict of interest where a family member of a minister, of the person involved, is receiving and benefiting from this public tender in the end. And finally, the Global Asset Registry, once it becomes applicable and enforced, would reveal about different assets held by John, in this case, in different parts of the world. Otherwise, if John held these assets, say, in the country, then most likely the asset registries of the country, say the local real estate property or the local ship register, should be disclosing this information. Most likely, John would own assets abroad, just to enjoy the transparency and maybe sometimes even the legal security of holding assets abroad in financial centers. And that is why it's so important that all these financial centers start disclosing and start joining this Global Asset Registry to start disclosing who owns what assets. In essence, these are the 4 policy asks, and these are links, hyperlinks to obtain more information about them. Interestingly, we have written a lot at TJN about automatic exchange of information, beneficial ownership, country-by-country reporting, and the Global Asset Registry. This is also covered by two of the flagship projects of TJN, and that is the FSI, the Financial Secrecy Index, and the Corporate Tax Haven Index. So just based on the examples mentioned here, automatic exchange of information will be covered mainly by FSI indicators 18, but also 1, 12, and 19. Beneficial ownership is mostly indicators 2, 3, 5, 6, 10, and 15. Country by country is covered both by the FSI and the CTHI, indicators 8 and 9 and 10 and 11 in the case of the CTHI. And the Global Asset Registry is partially covered by the FSI's indicator 4, which looks into free ports and real estate.